3.5 million. That is the number of fake bank accounts Wells Fargo employees opened in the names of real customers between 2002 and 2016, without permission, without notification, and in many cases without those customers ever discovering the accounts existed until the fees showed up. Fake checking accounts, fake savings accounts, fake credit cards, fake online banking enrollments tied to fake email addresses that employees created so customers would never see the confirmation messages. This was not the work of a few rogue branches. This was a 14-year company-wide scheme that the bank's most senior executives knew about, internally documented and protected. And when the regulators finally moved in, here is what happened. Wells Fargo paid over $5 billion in fines. 5,300 low-level employees lost their jobs. And exactly one senior executive faced a criminal charge. She did not go to prison. Today on Finance Log, we are walking through the documents. If you have ever opened your credit report and seen an account you did not recognize, or been hit with an overdraft fee on a checking account you did not remember signing up for, there is a real chance you were one of the 3.5 million. Wells Fargo employees were pressured by sales quotas the bank's internal documents called often unattainable. They opened new products in the names of existing customers to hit their daily numbers. The 3.5 million figure was confirmed in the California Attorney General's investigation. The Consumer Financial Protection Bureau's initial 2016 enforcement action put the number at 2 million, but a later expanded review by California Attorney General Xavier Becerra revealed the actual scale was roughly 75% larger than the bank first admitted. Wells Fargo paid Becerra's office an additional $148.7 million in 2018, specifically because they had understated the original count. If you are getting value from this kind of breakdown, hit subscribe right now and tap the like button. Finance Log is reading the source documents so you do not have to. We just launched, so every subscriber compounds the channel's reach in the first month. Here is how the scheme actually worked at the branch level. Wells Fargo employees were ranked against each other on daily scorecards, inside what the bank called the Community Bank Division. Their pay, their promotions, and in many cases their continued employment depended on hitting sales targets that the bank's own board later described as excessive pressure, producing impossible numbers. So workers did what desperate workers do when the choice is fraud or unemployment. They opened accounts in the names of real customers without authorization. They forged customer signatures. They created fake email addresses so confirmation emails would route into accounts the customers could not see. They transferred small amounts of money from real customer accounts into fake ones to make the fake accounts look funded. They issued unauthorized credit cards. They enrolled customers in unauthorized online banking. And customers paid for it. Real customers got hit with overdraft fees on money they had moved through accounts they did not know existed. They got hit with monthly maintenance fees on checking accounts they had not opened. Some of them took credit score damage from credit cards they had never applied for. The Consumer Financial Protection Bureau ordered Wells Fargo to refund affected customers, and the initial refund estimate was $2.5 million in fees. The final number across all settlements and consumer compensation programs ran into the hundreds of millions of dollars. Share this video with anyone you know who banks with Wells Fargo or did in the last decade. There are still customers discovering unauthorized accounts in their names today. The cover-up at the executive level is where this story turns from corporate fraud into something that should make every American furious. The Department of Justice's filings in the 2020 settlement lean heavily on the conduct of an executive they refer to as Executive A, described as the head of Wells Fargo's community bank business, and the regional bank division from 2002 through 2017. That person is Carrie Tolstedt. According to the Department of Justice, Tolstedt was aware of employees using fraudulent means to achieve sales goals as early as 2004. One Wells Fargo executive wrote in a 2004 internal email that they wanted Tolstedt to be constantly aware of this growing plague. A plague. That was the word used internally to describe what their own workers were being forced to do to hit their numbers. Tolstedt did not stop it. She ran the division that produced it for the next 12 years. The criminal charge against Tolstedt eventually came in March 2023. She pleaded guilty to exactly one count: obstruction of a bank examination. The charge was based on a memo she helped prepare in May 2015 for Wells Fargo's Risk Committee, which she knew would also be provided to the Office of the Comptroller of the Currency. That memo failed to disclose the number of employees who had been fired or resigned amid investigations into sales misconduct. According to the DOJ, the bank's internal investigation at the time only looked at the most egregious 0.01 to 0.05% of employees flagged for potential sales fraud. The other 99.95% of flags went uninvestigated. Tolstedt's memo helped keep that hidden from federal regulators. She was sentenced on September 15, 2023. Federal prosecutors recommended 12 months in prison, arguing that a custodial sentence was necessary to send a deterrent message to other bank executives. U.S. District Judge Josephine Staten rejected that recommendation. Tolstedt received 3 years of probation, 6 months of home confinement, a $100,000 fine, and 120 hours of community service. She did not go to prison. She was the only person criminally charged in connection with a 14-year scheme that opened 3.5 million unauthorized accounts. The OCC ban from banking and the $17 million civil penalty already imposed on her were treated by the court as enough. Meanwhile, the 5,300 lower-level workers who got fired did not just lose their jobs. In the financial services industry, when a worker is terminated, the firm files a regulatory document called a Form U-5 that becomes part of that worker's permanent industry record. Many of the fired Wells Fargo employees had Form U-5 filings that flagged them for sales practice violations, the exact misconduct the bank's quotas had forced them to commit. That U-5 designation followed them out the door and into job interviews at every other bank, credit union, and brokerage in the country. Workers reported being effectively blacklisted from financial services entirely. So the ledger reads like this: 5,300 working-class Americans lost their careers, their incomes, and in many cases their ability to ever work in finance again. One executive served 6 months at home. 0 executives served any time behind bars. Subscribe to Finance Log if you want the follow-ups on this story. We are tracking the remaining OCC enforcement actions against the 7 other Wells Fargo executives still facing administrative proceedings. Former CEO John Stumpf was treated similarly. He resigned in October 2016, shortly after testifying before the Senate Banking Committee, where Senator Elizabeth Warren told him to his face that he should resign, return his earnings, and be criminally investigated. The criminal investigation never produced a charge against him. In 2020, he settled with the OCC for $17.5 million and accepted a lifetime ban from the banking industry. Between Stumpf and Tolstedt, Wells Fargo's board clawed back roughly $136 million in compensation. That sounds like a lot until you do the math. Stumpf earned approximately $200 million during his time running Wells Fargo. Tolstedt earned over $125 million. After clawbacks, fines, and settlements, both walked away with tens of millions of dollars and never spent a single night in a jail cell. Compare that to the 5,300 workers, mostly tellers and personal bankers, earning $15 to $20 an hour, who lost their jobs for committing the fraud the executives' quotas required them to commit. That is not justice. That is a sorting mechanism that punishes the bottom of the pyramid and protects the top. The pattern goes far beyond Wells Fargo. According to research published by Better Markets, no executive from any major U.S. financial firm faced criminal charges for conduct related to the 2008 financial crisis, which was the worst economic event since the Great Depression. Tolstedt's home confinement sentence is now the harshest criminal accountability any senior bank executive in America has received for systemic fraud in over 20 years. The message that sends to every boardroom in the country is the one the prosecutors warned the judge about. If you are senior enough, the rules do not actually apply to you. If you ever banked with Wells Fargo between 2002 and 2016, there are 3 things the data supports doing right now. First, Pull all 3 of your credit reports for free at annualcreditreport.com and look for any account from Wells Fargo you do not recognize, including closed accounts. Second, file a complaint with the Consumer Financial Protection Bureau at consumerfinance.gov if you find anything suspicious. Consumer Financial Protection Bureau complaints get tracked, get responses, and have been the single most effective tool for forcing banks to refund consumers in the last decade. Third, check whether you are part of the existing class action settlements. Several remediation programs are still processing claims. The bank does not advertise the remediation programs aggressively because every claim filed is money out the door, but the programs exist, and the money is yours. Comment below with one word, Wells, if you ever banked with Wells Fargo and want me to do a follow-up video on the specific remediation programs you may still be eligible for. And if this is the kind of breakdown you want more of, hit the bell so you do not miss what is coming next. A quick note before we close. This is editorial reporting and analysis, not legal or financial advice. If you believe you were harmed by Wells Fargo's practices and want to pursue a claim, talk to a licensed consumer protection attorney about your specific situation. Thank you for watching Finance Log. See you in the next one.